It has been an interesting few days, to say the least, when it comes to global markets, when it comes to what happened in China recently, what happened in Europe, and of course what's going on in the US domestically. And we got a lot to talk about in this video. So I want to start today with what's going on in China. Every 5 years in China, they have their party congress, so that's normal. But what happened was a little bit interesting, and maybe the results of the party congress are leaving people talking and actually leaving markets a little bit spooked, getting close to October 31st, interestingly enough. So what happened? Well, Xi is sitting next to his predecessor, and what it seems like is as the foreign press is allowed inside of the party congress, there's like a political power move going on. They remove his predecessor. And I think what at least the people who are smarter than me about this thing, because I do not know much about what's going on in China. I'm no expert, not an expert in anything, honestly, but I'm definitely not an expert in China. And so what happened there, people are just saying that it is due to Xi taking control and making sure that he can assert that he is in control of his political party and what's going on in China. He is the leader. As we can see in this market from Bloomberg, it does discuss a little bit about why this is kind of spooking markets. So stocks yuan extend losses on Monday as party congress ends. Traders worry leadership filled with Xi's allies may disappoint. The market meltdown following the reshuffle, which highlighted Xi's unquestioned grip over the ruling party, shows deep disappointment over a likely continuation of policies staked on COVID-0, state-driven companies. And so what's going on here is, so the free market dynamics going on in China, they don't look like it's going to expand. It looks like that's not going to be something that is going to be good for Chinese stocks, for example, Alibaba. And if we take a look at Alibaba, before the drama unfolded, Alibaba was actually down almost 41%, just over 41%. After the drama unfolds, it's down 47%. Look at this gap down, and man, this thing intraday got down to over 50% down. So it was not a good reaction to Chinese stocks. So that is not a good thing if you are investing in stocks like, let's say, Alibaba, Chinese stocks. A lot of people on Twitter, to a FinTwit, who are big Alibaba investors, are saying, well, basically, all we got to do right now is we're just going to hold and wait and see what happens. Like, we're not going to sell, but we're definitely not buying more. That kind of seems to be a consensus about what's going on as the potential political climate in China, the economic climate, changes a bit. You can see here the HSI was down almost 5%. So it's actually, I think, the worst day since the financial crisis in the Chinese market. So obviously, not a good time to be investing right now in China, at least this past few days. Let's move on to Europe before we head over to the US and see what's going on in the US. So basically, this is S&P Global Flash Germany PMI Composite Output Index. So basically, Price Manufacturing Index. And so not looking good. We have a giant drop. You could see one bubble to rule them all, saying German PMI release again, dire and worse than expectations. I really recommend you read the whole accompanying press release at the link below. The link is actually to an S&P Global analysis, and it's talking about Germany PMI seeking deeper into contraction territory in October. Basically, it's just not good. What's going on in Europe, PMI is important. It can be a leading indicator of recession. So it's not looking good for having a PMI that's going to be down this drastically and this fast. There was a lot of things going on Twitter, on FinTwit, like the past few months about this whole energy crisis that was going to potentially occur in Europe. And what happened? Well, what's interesting? Like, there's like these LNG ships that can't even get into the Spanish ports because there's like the demand isn't there right now because it's such a warm, I guess, climate right now. The LNG terminals they're just like, there's not enough demand or whatever. So again, not an expert in that, but this whole thing thought about an energy crisis happening in Europe right now, it does not look like that's going to happen at this point in time, at least. There is just a surplus of natural gas that is essentially going to allow them maybe to get through a cold winter if one does occur. I don't know if it will, but that could maybe be a bullish sign on Europe. I'm not sure. So if you're someone who invests in has European exposure, even if you just have like the VXUS, right? So the global index fund at Vanguard, then you have probably some European exposure in there, and you might want to know about what's going on in Europe. Let's jump to the US now. So Wall Street Journal, and this was an interesting thing that kind of was flying all over Twitter recently. Basically, people recently were not talking about the Fed put anymore. They're like, it's done, no Fed put. Well, okay, there are people that have still been talking about the Fed put, but they're basically saying new people are jumping in, I think, the bandwagon of the Fed put, and now saying, well, I think that it's possible that the Fed is going to stop increasing interest rates so drastically, there's going to be a Fed put. It's going to end up affecting the stock market in a positive, bullish sense. It's going to be really good for the stock market. Here's what's going on. So there was a Wall Street Journal article. It says Fed set to raise rates by 0.75 points and debate size of future hikes. Some officials are signaling greater unease with big rate rises to fight inflation. So what's going on here is that there are, I guess, people within the Federal Reserve Open Market Committee that are maybe starting to show signs of skepticism about how fast they are doing this whole thing. Maybe some of them are kind of scared about something ending up breaking in the economy, which a lot of people have been talking about potentially happening. So if we go back to why this matters, let's talk about, we have regular inflation, so headline inflation, then you have core inflation, which we've talked about a lot in the channel. So core inflation is when you take out energy and food out of the equation and you get core inflation. And core inflation in the US rose to 6.7% in September, its highest level since 1982, which is obviously not good. The Fed is looking very closely at these numbers, right? Now, why does this matter? And by the way, this is from Charlie Bolello. This is from his newsletter, which is great. So if you want to sign up for his newsletter, he sends some good charts out often. So the year-over-year change in the CPI of the different baskets here. So you have fuel and oil, you have gas, you have gas utilities, gasoline, electricities, right? So what's important in here, he talks about the driving core inflation. More than anything else, shelter, which at 1/3 of CPI, so 1/3 of consumer price index, 1/3 of what matters when you look at inflation is actually housing or is shelter, right? And so it's a very important part. And we have shelter here, which year over year from July was up 5.7%, then it went up higher to 6.2%, now it's up higher to 6.6%. And so people are talking about shelter, and it's an important factor in core inflation. So when we look at core inflation and we see it rising higher, well, the Fed might be saying, well, we're going to continue raising interest rates because we don't see inflation stopping anytime soon. Put this into perspective, where are we within the Fed funds rate, which is one of the tools that the Fed is using to try to fight inflation. When they talk about whether they're raising interest rates, they're talking about the Fed funds rate, right? And so right now, the Fed funds rate, let's say it's around 3.25%. And this is how it's been historically. Of course, we are higher than it was back when it finally got up to about 2.5% back July 19 before COVID. And now look how fast it has risen. And it's just very fast. And it's so fast that people are scared of it starting to break things. And I think there's legit concern about that. And now we're talking here about the probability, and let's go back for a sec, the probability of this going up higher to, let's say, 4.75% by December. And so probability of 75 basis point hike at the December 14th FOMC meeting. So the rate would be 4.5 to 4.75 if this happens. So this is basically measuring what's the probability. What does the market thinks is going to happen? Do they think that this is going to get this high? And what we're looking at is there's a 75% chance that this does occur. And so that's basically based on futures pricing of interest rate hikes, right? So here we have Jim Bianco, pivot talk again, especially futures up, ES futures up 30 points in 10 minutes. If 75 basis points on November 2, another 75 hike on December 14 is 75, year-end funds 4.5 to 4.75. The Fed only has two ways to step down, 50 in December, one, pivot, and stocks moon. So what he's saying is, if they don't go to 75 basis points, which is what the market thinks, and it goes to 50 basis points, then stocks are going to drastically go up. It's going to be very, very, very bullish for the market. We're going to have a face-ripping rally probably, right? This is what he's saying. And honestly, it probably will happen because the second that the Fed shows that they are going to stop increasing rates so fast is probably the moment when the market is going to rip our faces off to the upside. And it's going to be a big rally. You know, that's probably what's going to happen. And then the other potential thing would happen that the data basically, it looks really ugly, right? So we get some really bad numbers in that the economy is really turning, recessionary numbers, and the Fed's going to be like, well, you know what? I think we overdid it. We're going to step back a little bit off the brakes. And so these are the two things that could potentially happen. One is that, well, things get so bad because they have been hiking so fast. Well, it's not good and things ended up breaking and it's not good for the economy, probably bad for the stock market. Or then they do say, well, you know what, we are scared of breaking anything else and we're going to just go to 50 basis points in December, in which case then we might have face-ripping rally. I don't know. We'll see. I'm not sure what's going to happen. I want to end on a positive note with that face-ripping rally here. So we are not in the year 2008. So this is not your 2008 crisis. Households have deleveraged massively ever since. And so here we have total household credit to GDP. We are nowhere near what we were back then. The credit market is much stronger. The consumer, the household, is much stronger than it was back in 2008. So this is a good sign for people. If there is a recession, they have a better withstanding potentially. Their household setup from a debt perspective is better than it was back in 2008. So that is a good thing. That's positive news. And the last thing I want to talk about here, Walter Deemer. And sorry, by the way, there is construction outside. If it's kind of loud, I apologize for that. So bear markets have two components: price and time. Price takes your money, time takes your patience. All those rallies that turn out not to be the beginning of a new bull market, even though so many people think / wish they were, eventually just wear almost everybody out. And this is so true, and I talk about this all the time. I'm still investing in this market. I don't care that the market keeps, having bear market rallies and then falling to lower lows afterwards, because I'm a long-term investor. I'm net long-term. I'm happy to get stocks right now at lower prices. So I'm happy to do this right now. This is something that you need to be aware of, because this is something that happens to everybody. And as long as you know that it's happening to everyone, maybe you can withstand it, because by the time it gets to that time that you should be investing, which we're going to talk about right here, it's probably going to be too late. And this says bull markets traditionally launch 3 months after a recession ends. So starting to see forecasts of a recession starting next year and lasting a few quarters or until 2024. If so, market might go through some sort of basing process for the next year, unless something breaks, of course, and the Fed takes out, economy, and that could be bad too. So anyway, on a positive note, just remember, long term, it's probably a good time to be investing, in my opinion. That's all I got for today. Disclaimer here. Thanks so much for watching. See you next time.